Assalamu alaikum and good morning to everyone, and very happy new year. I'm pleased to be starting this new year from my very favorite place, Kerala, and I hope that it is a good year for all of us. I'm also thankful to Mr. Mansoor Ali, Chairman Vibjor, and all his team members for inviting me to this event. And I hope that the effort that we are going to make today is helpful to all of us in understanding microfinance, its different models, what are the Sharia issues, how it works, and how we can make our life better by use of financial instruments and financial institutions for the benefit of all. That's my idea. I will request that please make note of your questions. That will be better for all of us. If you get a chance to clarify your doubts, if you get a chance to talk and make comments also. So I will try to cut down on my presentation in the hope that you all will participate to ask questions, especially to students that I see around. It will be great if you ask questions, clarify your doubts, and share your inputs as well. So this is my topic today, Islamic microfinance models and tools. And I'll try to focus on, so while introducing microfinance, I'm sure many of us already know about it, but we'll try to see what more perspective we can bring onto this discussion. We will discuss about microfinance models practiced in our country as of now. We will also try to see what are the major criticisms and challenges in microfinance. And there have been number of crises that microfinance industry has faced over the last 2 decades in our country. That also is a part of our collective learning. I'll try to shed some light on those learnings, as I have been myself a part of microfinance efforts in various forms and shapes. And then we'll try to move on to Islamic finance. And time permitting, we will also try to see which are the real case studies for us to see how Islamic microfinance can practice on ground. So this is the agenda for my talk today. Here we go. Some of the case studies, time permitting, I will highlight. Otherwise, we will utilize that time for Q&A. Now, so microfinance itself refers to provision of financial services, not only to in small sizes, but to people who usually fall outside of the formal financial system. That is the definition of microfinance. And microfinance in general is not only credit, although in our country microfinance basically is microcredit. You know, when people are able to save even a smaller amount like what is happening at Vibjor here, it builds on their saving, it builds their capacity, it converts debt saving into capital formation. That is the theory of microfinance. So not only microcredit, but micro saving, microcredit, micro remittance, as well as micro insurance. That is the gamut of entire microfinance segment. Unfortunately, saving, remittance, and insurance are hardly available in our country, and therefore we are happy to only with microcredit and calling it microfinance. That is what is right. So, whereas a poor person not only needs credit, a poor person may also require a saving opportunity. If somebody is having 5 rupees or 10 rupees or 20 rupees saving, why that saving should not be converted into capital for the country? That is the idea. But the big financial organizations have least interest in mobilizing such a small saving, and therefore those kind of savings which can be trillions of dollars or trillions of rupees in India's rupee term are remaining uncaptured, unutilized, unmobilized. So microfinance institutions can be using this. Remittance has become easy now, but there was a time when remittance cost was about 5% or up to 10% transferring money from one to other place. But thanks to National Payment Corporation of India, UPI and various other things, in the last 10 years, this problem has been resolved to the best of options. We can now transfer money from any place to anyone for any small amount and without any cost at all. So now what we are going to discuss more about microcredit. Now, why microfinance? So after moving from what is microfinance to why microfinance. So poor people or people who do not have high income, they have inadequate income, therefore they have no saving. Because they have no saving, there is no capital formation. Because there is no capital formation, there is no investment. And there is no investment, and therefore they have again low income. So poor people remain in the vicious cycle of low income, because whatever is small they have, that cannot be saved, that cannot be mobilized, that cannot be converted, and therefore they have no option but to spend that and remain poor. So microfinance is first needed to break the vicious cycle of low income. If people are able to save, they will be able to convert that saving into capital formation. That is one why microfinance is needed. The second is microfinance is needed to meet consumption and contingency needs. Most of the people in our country who have come after hard work of years above poverty line with one incidence of health or something like that, they go back to poverty, and years of efforts bringing them out of poverty goes waste. That is the condition. Especially with something happening like health condition, people become poor and the whole family suffers immensely because of unforeseen expenses related to consumption or health condition, or maybe marriages, maybe education, etc. So microfinance is also needed to meet consumption and contingency needs. The third reason why microfinance is needed is to provide an alternate to formal financial institution. We have seen that country's financial system was nationalized in 1969. Insurance was nationalized in 1956. Despite nationalization of financial system, people could not have bank account until the technology enabled them in the last 10 years. So why? Because financial institutions, especially banks, were not interested in capturing a small amount. So there is a need to provide an alternative to formal financial institutions. Why? Because formal financial institutions give lending on project based. When you go to borrow from a bank, they will ask what for, number one. Second, they will ask for collateral, what guarantee you provide. And third, they will be less interested if your amount required is small, because the cost of operation for them is quite high in terms of monitoring and transaction cost. So banks are like big nets which are not interested in any small size of fishes, and they will only look at big ticket, big size. Have you ever wondered that none of the unicorn companies have ever come into light through financial support from bank? Bank cannot see your brain. Bank can only see what collateral, what guarantee can you provide. And therefore, any economy that has to capture the imagination of entrepreneurs cannot survive through banking finance, because the model of bank itself is not supportive of entrepreneurial culture. It is supportive of, by design, it is supportive of the security culture. And therefore, all the big companies that you can name, initially they came without banking support. Once they became big, then they started relying on banking support, or banks started chasing them to finance their requirement. So microfinance is needed for all these purposes, to break the vicious cycle, to meet consumption and contingency needs, and to provide for alternative to formal financial institutions. Now, coming back to where I started was that microfinance should be micro saving, micro credit, micro remittance and micro insurance. But for regulatory reason, what we do today in the country, especially our country, is micro credit. Now, what are the models for micro credit? Yeah, yeah. Let us leave it here. It's working?
It's
Okay.
This is forward.
Okay. Okay. Thank you. Now, there are two models. Initially, we started with individual lending, but nowadays microfinance is basically group lending. And in group lending, there are three different variants. One that is known as very popularly Grameen model. Anybody can guess what is Grameen model, or do you remember why Grameen model is so popular? Anybody? Any student? Yes. So, first time ever in the history, a banking model was given Nobel Peace Prize. Okay? And this is the model that we are talking about, Grameen model. Students, you should be aware of, right? So, that is one. Then there is something very unique about India's own effort, especially the social sector led by government, and that is known as SBLP model, which is SBLP is nothing but self-help bank group linkages model. This is second. And then what Indian private microfinance institutions have adopted from Grameen model is known as JLG model, which is joint liability group model. So, as of now in our country, these models are in practice, and of course, a good number of microfinance institutions, especially cooperatives, rely heavily on individual lending, but by and large, the for-profit microfinance rely heavily on the group lending model. Okay. Now, very quickly, this is how Grameen Bank started. So, one person is interested in getting loan. They will ask that one person to join a group of 4-5. Then all 4-5 will be given some kind of financial literacy program, financial literacy training. After they have learned how to calculate money, okay, after they have learned some basic financing, how to account, how to save, how to write notes account, etc., one of them will be given loan and others will be waiting till this person pays. And that way, once that this person has pays, the other will get, then other, then everyone will get. Over a period, Grameen Bank realized that women are better borrower, right? And with experience, why they are better borrower? They are not as mobile as men. They stay closer to their families. They drink less. They lie less, and they take more peer pressure. Since microfinance was not giving loan based on any collateral because the borrowers were not having any kind of collaterals to offer, over a period they realized that other people will make sure that the first person pays, because other people's loan are dependent on first person payment. So this is a kind of peer pressure, and peer pressure is applied good through women than through men, right? This is just psychological behavior, and over a period they realized that women are better borrower, and they started focusing giving loans to women, and today 80% plus microfinance borrower would be females. Now when this happens, there is always a credit for women empowerment. So basically, women empowerment, yes, somebody could be very keenly interested in women empowerment, but reality is that women are better borrower than men, and therefore anybody giving loan to gender based loan to anyone, any gender, will definitely rely more on female than male. That was the reason, and then it is how it started working, and it reached to millions of people. These are some details. I will not go into those details to save time for you to ask questions. Okay, so how meetings happened, how many loans happened, what kind of service charges or interest were charged, etc., etc., etc. This is something I am leaving to save my time, because I have already been introduced twice and a couple of minutes has been consumed on that. Right? We move on to next one. This is India's model, and this came through support from German social organization NGO, and they wanted to see that despite nationalization and all the efforts that government of India has been doing right since independence, India's more than 50% adults could not have bank account, and leave alone females. Even males did not have account. And not more than 8% of the total people who had banking account could borrow from bank. That means 50% population is not having even bank account at that point in time, in 90s. And not only more than 8% people could borrow. That means 92% people in the country could not borrow from banking system at all. At that point in time, an idea was floated that if people are poor, bank cannot operate on a smaller size, then can we not make people join together to become, as a group, become a worthy banking client? So that was the idea. So what happened? Here is a bank, and let us say in Mallapuram or some social organization NGO is there. It will go to some rural areas or anywhere, encourage 15-20 people to join together, and these 50-20 people, once they join together, because independently they are not bankable customer, in the sense they do not have enough amount to save, and they cannot borrow from bank because they do not have collateral. Now if one person cannot, can we try by making 20% open one single bank account? This is the idea, where SHGs were formed, and SHGs for the purpose of banking account were considered. They could open bank account in their common name. Now 20 people will save money together, and after 5 or 6 months of saving and some financial understanding developed, the bank was encouraged to give matching loans to the amount people had saved. So if 15 or 20 people had opened one common bank account without having any kind of registration as a company or as a group, etc., then, and let us say if they have saved for in 6 months, say they have saved only 10,000. So bank will give matching credit. So total option available to these guys, this team, would be 20,000, 10,000 their own saving, and 10,000 loan approved by bank. Now these people with leader, they can give loan to their own group, and they can keep recording and monitoring, etc. So part of due diligence was transferred to the same group. They were encouraged to save, they were encouraged to take lending decisions, and bank's risk was much less than otherwise. And this is how it started working. Today more than 100 million families have SHG account, right? And here is the detail. So it was launched in 1992 on pilot basis, and then slowly it started, more and more people started forming group, they started opening bank account, they started collective saving, they started borrowing from banks, and then they started lending to their own group, and all this. So this NGO earned commission for providing bank account, opening bank account through self-SHGs. These people got an opportunity to save and get loan, and bank got customer who otherwise were non-worthy customer of the banking section. That is SHG model. Moving fast forward, we have, this is private sector microfinance business in our country. Now here it is non-banking finance companies basically. So those who know about India's microfinance sector, they know that microfinance sector is one under RBI known as NBFC MFI. That is one registration under RBI. You form a company, and then your company is into microfinance business. RBI will categorize that company into MFI, microfinance institution. There are other set of institutions, trust, not-for-profit organizations that also are active in microfinance, but those are not part of regulation under RBI. They come under a self-regulatory organization called Sadhan, right? So there are two segments, but by and large, India's microfinance is under NBFC MFI. Now what happens? A for-profit company comes, it borrows from bank and it gives loan to customers by making group. So the company will come forward to give loan. It will not form group on its own. It will encourage you come for loan, and then NBFC will say you come in a group of 5. NBFC will not have any role to play in that. So you form a group. Now NBFC will give loan to one and ask others to wait until she pays. Then next, then next, then next. Exactly the same that learning of Grameen Bank was there. But here it is for profit. So all the people will form a group. One will be given loan. Once she pays, the other will be given loan. Once she pays, then other, and so on. The cycle will complete. Now, these are the details. Again, I'm not going to discuss more on this. I request organizers to share the presentation with anyone who is interested, so that we can pay more attention to the discussion that is going to happen. You can take the copy for your record or maybe for your further study. Moving further, these are the criticism and challenges of India's microfinance sector. And actually, these challenges are very much linked to what is the next slide going to say. But by and large, it is blamed, and not wrongly, that India's microfinance sector charges not less than 24% interest rate in an environment where the normal interest rate range is 7 to 8, 9%. Microfinance, the poorest lady in our country pays the highest amount of interest. The biggest people in our country will pay 7%. The poorest lady in our country will pay minimum 24%. That is the complaint. Now these are the complaints, and RBI had established a committee in 2017-18, or maybe earlier, YH Malagam committee, and the committee came forward with all the problems that India's microfinance segment was facing, and these are: so microfinance companies will collect security deposits and charge very high interest rate, and then how they calculate this 24% also was very untransparent, right? Some of them would appoint themselves as a customer to the client and charge consultancy fee customer is not even aware of. Those kind of costs were there. And then business model was such that many of these NBFC companies were hoping to get listed at the stock market, and therefore they wanted to show a big size of their loan. They wanted to show a big loan book. And how can they increase the size of loan book? They do not want to work hard to reach more number of clients. They wanted to give more loan to the same client. And that problem led to multiple lending. And since these companies were asked not to show bad loans, so once a person has defaulted, they will give loan in the name of other person to the same person, just to make sure that the loans are recovered. So most of the time, new fresh loans were given to recover old loans in the garb of another loan or fresh loan. So the recovery was very great in the microfinance institutions' balance sheet, and the size of customers was also increasing. But in real sense, this was building up a crisis in the microfinance, where ghost borrowing, over lending, multiple lending were leading to indebtedness of the poorest segment of our society. And when this happened, many microfinance institutions started coercive methods of recovery of loans. So they would go to houses, they would take out something, they would take animals, they would take hand pumps, etc., to recover and say that you pay. And this led to number of suicides in microfinance segment, and that led to India's first crisis of microfinance that we will be discussing in the next slide. Added to all these problems, Muslim customers have two additional issues. Number one, this is all interest based. Now, on one side they are faced with poverty, on the other side there is religion coming in between. Interest is not allowed and you are paying interest. This was a very painful burden to the community that already is poor, and then having to compromise on their belief was a very heavy burden on their chest. The second problem in the society related to microfinance is that mainstream microfinance are focusing more on giving loans to women, and Muslim culture doesn't allow that. In the morning, first thing our women do is rushing to the microfinance office and fetching some loan. Many times people started feeling that it is assault on Muslim culture, that females, instead of giving more time to their family, spending more time at their house, they are running around to fetch loans for the family. And these are two additional problems. So these all are the problem as far as mainstream in microfinance is concerned. Now, India's microfinance industry has faced several notable crises in the last 10 years or so. Huge crisis. The first came Andhra Pradesh loan crisis. This is the period 2009 to 11, yes, when Government of India under RBI established a committee to look at the crisis and the problems faced by India's microfinance, and all the challenges that I mentioned a couple of minutes before actually is from the report of this crisis. And I'm talking about official reports, I'm not talking about unofficial report. Then demonetization happened, and you all know that the notes were demonetized, no longer in a legal tender. Now, when this happened, microfinance institutions which had given loan to people, and people were paying back depending upon the sale they were doing in their normal small businesses, there was a cash crunch. And that cash crunch led to non-payment of loans. And that non-payment of loan led to huge liquidity crisis for the microfinance companies. This followed by GST, etc. That was another very important crisis in the microfinance sector, although in a way it was good for the economy because there was tax reform, but it impacted very badly the smallest segment of the society, or the smallest traders in the community or the society. And then followed by COVID. All these crises have impacted microfinance industry in India in a very different manner. What has been the learning? These are who did well, right? These are those with a stronger internal financial system. They were able to cope up with these challenges, right? And there is a learning why I have noted this slide at this place, that if you are strong financially and in terms of cash, you will be able to cope up with the crisis. If you are short on liquidity, your investments are into illiquid asset, some crisis comes, you will be facing a lot of challenge, and some of them could go bankrupt as well. Now, this is one challenge. Another was, if you look at all the four crises, I have summed up the learning of all the four crises into one, and those who took better care of their staff and clients survived better. During COVID, it was not a mistake of staff for their inability to recover loan. Many companies fired their staff hoping that this is the only way to save cost. But when COVID was over, they did not have field staff to recover the loans. They went bankrupt. So all those organizations which took care of their staff in bad time, they came out strongly in good time. So it is immensely important that organizations, especially financial institutions, take good care of their staff and client both. This is also very important. Third learning, all those organizations which face problem, one way is that you suffer silently, another way is you make your regulator know the problem that you are facing. Those who were open to share their problem with the regulator ultimately prevailed upon regulator to understand their situation, delay their accounting procedure for non-performing assets, etc., etc. And that way they could qualify, they could survive the period of challenge, and later on they recovered faster. And believe it, regulator support is very, very crucial when you are into financial sector business. So these are the learnings for financial microfinance. Now, we first pray that there is no crisis, but if something happens, what to do? And this is, first, is focus your energies on identifying and assess and prioritize risk. If you have got two risks, look at what is more important for you to handle first. Don't look at solving all the problem. Only focus on solving the most critical problem. People who focus solving all the problem at one time, they often fail. People who focus on solving most of the critical problem at one time, they often succeed. So first learning is identify, assess and prioritize your risk. Then develop strategies and policies to measure those risks, and then design policies and procedures to mitigate those risks. Then implement and assign responsibility to people who are responsible for, and then following, test effectiveness of your policy, and then revise your policies and strategies if required. Don't think that you know everything. Always monitoring, revision helps you, and those who do well and those who did well during crisis, they were able to come out in flying colors. Now, very quickly, so this is the context of India's mainstream microfinance. Mainstream, why microfinance is needed, what microfinance is, what are the models, what are the challenges, etc. We have discussed. Now we move to Islamic microfinance. Now, 15 minutes? How much? 15, 20 minutes. Okay, thank you. So, now when we come to Islamic microfinance, Islamic finance contracts, basically three kinds of contracts are most prevalent as far as the summary of Islamic contracts are concerned. Now, one is partnership, other is exchange or sale, and the third is gratuitous, not for profit, only to help others. Entire Islamic finance contracts could be identified into these three types, and within these three types, in partnership we have musharaka and muzaraba. Students who are from Islamic finance field, they know already, right? You know that. Okay, good. So musharaka and muzaraba, I may not have time to go into details to save my time, but basically this is pure equity, and this is a partnership of capital and entrepreneurship. These two are, right? So you can be partner through your labor and money both, and you can be partner where somebody is contributing capital, other is contributing entrepreneurship, and they are joining together to share the fruit and they are sharing the risk. That is what these contracts are. Moving very fast, very quickly to others. Now, this is a sale contract. You sell something on credit and charge high price. That is known to all of us in the era of finance NBFCs. Now, ijara. I tried giving color and it is not coming well. Ijara is basically renting out. So you rent out your asset, like you rent out your houses, you rent out your hotel rooms, you rent out your restaurant places, you rent out your office spaces. So ijara is nothing but that. Salam is forward contract. So these all are basically somebody is paying to hire assets, buy assets, or procure asset for a particular period of time. Now, very quickly moving to gratuitous. Islam encourages people to not only to do adl. Adl is compulsory. Doing justice is duty of Muslim, but beyond that, doing ihsan is highly rewarded. And all this is doing ihsan. So you create social entrepreneurship, support people, support community, support society is what? So this is all business, risk sharing, this is trading, and this is gratuitous or social entrepreneurship. You club this all and you have Islamic finance contracts available here. Now, if it is Islamic finance, then those who know accounting, they will say what is the source of fund and what is the application of funds. So, source of fund, if you look at 50 years or more than that, the history of our country, initially Muslim community microfinance started with charitable contribution. Rich people will give donation to some organization and those organizations will support poor people. It's a small amount here and there. Those were the first organizations, types of organizations in our country. Then people started having deposit based organization. Now this could be WIPJOR, this could be microfinance, cooperative societies, etc. You save your money through them, and all the money that is collected, the organization collecting it will pass it on to people who need fund based on the contracts that we have just discussed, and the profit coming from that or the cost required from that will be used to pay for running the organization. So those are the deposit based. Equity based microfinance, I have put a question mark. Anybody referring to me which other organization they know, if there is any about equity based microfinance, we can give some award to them. And then there is a membership fee based. This is more like club. People joining together to pay a fee, and then through that fees some amount of financial support can be given to the same member. These are on the liability side. This is on the asset side. The same contract that we have just discussed could be utilized to give funding support to the people who are in need. Now, this is one organization in India. I have got two case studies. One of this is this. We started in 2011-12. Within next 14-15 year, they have got 65 cooperatives under their belt, 120 branches. They have got share capital of 50 crore, membership of around 400,000, deposit of about 22 crore here. It will be more actually now. And then deposit balance, 225 deposit mobilized, 388 crores deposit, loans about 64 loan disbursement 641 crore, and loan outstanding is about 305 crore. So out of the deposit of 388 crores, 305 crores of loans were given, or financing were given, and then roughly about 100,000 loan beneficiaries. Average loan size is 66,000 and turnover is about 289 or 2000, sorry, right? 3,000 crore turnover, yes. How many times you give loan, recovered, and again give loan, so that is thing. Now this is one type of organization. Hopefully WIPJOR is working fast forward. If they are able to get your support, if they are able to work faster, they could be multiple times more than this, because here the government has stopped giving license to multi-state. So now these organizations are creating smaller societies in each state and making them join together. The organization that Mr. Ali Mansoor has got license for 16 states with one entity. So that is the kind of scope you have if you are able to do well. And my best wishes in New Year that you do well. because it serves the society, it serves the humanity. Those kind of promises and those kind of opportunities are there. Very quickly moving further, this is one organization started in Bombay in 1973 and only to the extent of operating in Mumbai because the license doesn't allow it to go and beyond Mumbai to operate. Now, the organization has had a very tough period also where it was closed for many years and then again revived. And these are the data. I do not want to quote this data. It is there for record, but they have gold loan, vehicle loan, staff loan, group guarantee, micro loan, loan against deposit shares, etc., types of loans. These are the types of deposits: spot, saving, recurring, Hajj Umrah, and those are the numbers for share capital. So 21,000 new share members and total 87,000 in Mumbai alone, the shareholders of that, and you have this all societies detail. Major issues and challenges. Coming to summing up my discussion, I'm just about in a minute or so I'll be finishing it. Now, how to run microfinance operations efficiently. When we say efficiently, engineers know that the relationship between input and output is known as efficiency. When you have less input for more output, you are known as efficient. So how to operate, because you are going from place to place collecting deposit of a small amount. So the cost of mobilization is very high. What solutions can be brought in to make sure that the cost of mobilization is remaining low so that your cost of financing to the people also remains low and you are not only sustainable but also profitable. So the efficiency is and sustainability is the biggest challenge for Islamic microfinance. Another very important problem in Islamic microfinance is agency problem. Fact of the matter is we lie a lot. We borrow money for something and we use money for something else. And that is known as agency problem. People take money on the pretext of something and they take money. Once they have taken money, they go and use it somewhere else. Organization is not aware, organization is not able to calculate the possibility of risk in such situation. So how to resolve agency problem, because all partnership contracts will have high agency cost. Muzaraba and Musharaka is not possible anywhere in the world. We study in Islamic finance Muzaraba and Musharaka, but in real life we do not practice Muzaraba and Musharaka because of the potential of agency problem. Now, human capital. We do not have people who understand Islam, finance both at the same time. It is an evolving society. Somebody knows finance and somebody knows Islam, but people having idea of both are not there, so that is a problem. How to make staff motivated? Many a times Islamic microfinance institutions have staff who are working on a very small amount of salary. How to keep them motivated if the salary level is low is another challenge. And how to help them mitigate the risk the members face when they have contingencies issues. When you borrow for business, you are able to pay. When you borrow for expenses, how are you going to pay? And if that happens because of health issues, then do we have any micro insurance or micro takaful provision to support the society? So these are the issues microfinance, especially Islamic microfinance in the country have. The case studies, these are case studies. I will skip it here. I have, I think, spoken enough. So I'll give time now to ask questions and answers. Thank you very much for your patient hearing. Thank you.
Ijara, the people are generalizing. You are taking profit, but the banks are taking interest. What is the difference? The people are generalizing. That we are facing.
See, I mentioned this problem. When we do not understand Islamic microfinance, the first thing we guess is that interest-free means zero cost. And when a customer comes to office and then they get the shock of their life, oh, there is a cost. Then what is the difference between interest and you? So people do not realize that any capital that they're getting or any financial support that they're getting is coming from somewhere else, and there is a cost involved in getting it from there to bringing it to office and then passing it on to the person who is requiring funding support. People often believe, and that is our mistake in communication, when we say interest free, we actually not only say interest free, we actually convey cost of free cost. And there is nothing called free lunch in economics and business. So we have to make people understand that when we say riba free, it is not actually zero cost. There is a cost. The only difference is that the interest in the interest based system, the risk of capital utilization is shifted to the borrower. Owner is someone else and the risk is borne by the borrower. That is the problem of riba. But people think that the counter to it is all the risk of the capital will be someone else's and I will only enjoy the fruit of the capital utilization. That is not correct, and I think it will take some time to inform people that when we say interest free, and that is why we should avoid calling interest free, right? Because immediately it conveys people a message that it is zero cost. Actually, it is not zero cost.
I mean, when we were discussing about microfinance, we were mostly, focusing on microcrediting and the risks involved and the loan amounts and rate of loans and rate of interest and all. So we were saying around 24% interest rate on microfinance, microcrediting. So when we come to Islamic microfinancing, so will the microfinancing still be more profitable than a normal banks from the bank's perspective? In that case, wouldn't that be again a kind of exploiting to the society in the root level? That's one thing. And if not, if in case of Murabaha and Ijara, I hope the interest rate, the profit rates will be lesser. In that case, it will be easy for us to pool people for microcrediting, but how can we motivate people to invest, for depositing for the bank to lend money? Because again, the profit rate will be less. Interest profit rate will be less from the investor's perspective.
Thank you. The very serious question and the crux of all the problem. I wish I could solve it. These are real life problems and you will navigate only when you walk through it. Nobody can teach you how you are going to run your organization. You know where to balance, how to balance, right? These are the learning that cannot be given in theory because you are every day encountered with real life challenge. How to manage and lower the cost of financing to the people who are poorer and you wish to support them. That is the challenge. But you also have a challenge how to grow your organization, how to keep your organization sustainable so that you are able to expand your operation to serve more people, right? So these are real life challenges. There is no one answer to it. If I knew, I would have done that business myself. But unfortunately, that knowledge is there only when you are on the ground and in your particular situation, only you know the solution. One, Islam is not going to give you rule. Islam is going to give you a principle. La tuzlamuna wa la tuzlamun is an issue. When riba is prohibited, it is very clearly mentioned the same ayat after comma, la tuzlamuna wa la tuzlamun. You should not exploit and you should not be exploited. Now, it is the customer and the organization both know well which of one of them is being exploited and who is exploiter. So make sure when you say about Islam, you make sure that not your customer is feeling that they are exploited. At the same time, you should also convey your message that you cannot also not be allowed to be exploited. That is on one side. The other side is how to make the organization, what was that question? Did I miss that? The second portion of your question? Motivate people, right? Again, motivation comes with service, right? Many a times we try to have a shortcut, thinking that, lot of social media presence, etc., 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 can come. It comes. but it cannot be a solution to your long-term service. If your poor quality of service is known to everyone, no amount of social media presence can help you. So the best client are those who are the most silent client, but they will tell about you and your services to everyone without you being aware of it. Now, once you do this real service to the society, your staff will be motivated actually, because they are seeing your commitment to the client. And anybody who is not so much committed to their client, actually, in my opinion, are short-sighted. They think that they can fool the society. It is not possible. Many microfinance institutions, AKS, etc., they tried getting listed and getting rich overnight. They failed. So I think when we are serving people, we have to be, it is a very delicate way where a balance is required to communicate to the customer why you are charging that much. At the same time, you are putting your best effort to make sure that your operational efficiency is building up your experience, and then you are becoming less and less expensive in terms of your ability to reach out to your customer. These are very delicate balance, but very serious question. Anybody who cracks this code will be the king of microfinance or Islamic microfinance.
I was thinking, what would be an investment opportunity in such a bank, an Islamic bank in that case? Because I can understand the staff of the bank should be motivated for a lesser salary, for a pay cut, and of course from the bank side there can be a motivation, but how can we, microfinance is also consist of micro investments, right? Not just micro credits. When you were saying initially the larger banks were not bothering about the small money, aggregate of the smaller money that everybody possessed. So how can we make use of it in that case? Because the interest, the profit rates will be, what I get on my investment will be less, right?
See, again, I'm afraid I may not have direct answer to your question. When you have a financial institution, right, you actually produce and sell nothing. You only deal in trust, right? You will not open a bank account in the bank that you trust is not going to survive. You will not give your money to a wealth manager you don't hope to earn for you. You will not buy insurance policy from an insurance company you think will not pay you when you need it. So in the financial sector, unlike any other sector where you are immediately giving something to someone so that someone is happy with whatever they are getting, they know the price of it. But in financial sector, it is the first and the foremost thing is the trust that you are going to gain. If you are not able to gain trust, you will not going to grow. Remember the image of our Prophet ﷺ in this occasion now, right? When he was forced to leave his most beloved city, he still made arrangement that all the amanat that were given to him is discharged by his representative Hazrat Ali, and he is not going to leave the city before all the amanat that was given to the Prophet is returned to the people who owned it. That kind of amanat is required. The concept of amanat is required for that. Once you have that, the joy of running a big finance company and helping poor is something that nobody will ever forget. Forget about profit that you will have. The pleasure that you have in serving one of the most poorest segment, one of the most needy segment, is something that will give you a joy for your life. And I think that is the motivation point for entrepreneurs. When they serve the society, when they bring a smile on a poor person, there is no greater joy than that.
My question is about the Sharia perspective of the microcredits. As you said, it's very popular, but in the kitab, we can see that kullu manfaatin, kullu qarlin jarra manfaatin fahuwa riba. So, if we are giving a microcredit and the payer it comes to a default position or a delayed position, is there a fine for the loan taker. If there is a loan, that should be connected to the fine is connected to the loan, then it will be a manfaat from the qard, so it will be riba. So how can this bank giving the credits can make profits from these loans or the microcredits? That's my question. Thank
Good
you.
question. Who will translate this question in English, in Malayalam? Yes. Who will raise their hand? Have you not studied? The question is a very important question, right? Who will translate that in Malayalam? I only understand Malayalam, right? So you have to. Nobody. Okay, that's a very important question. Now, any loan that brings profit is riba, right? If I can say in English. Now, here we need to see that a loan is bringing profit to whom, right? The loan is contributed capital from the depositors. Depositors are not earning profit out of it. It is the organization which passes the loan by collecting it from the saver to the borrower, and the cost of this transaction is passed on to the borrower to run the show, otherwise money will not be able to mobilize and passed on to you. So the cost of recovering or the process of recovering the cost is not nafa, manfaat is not there for that, right? That guy is not benefiting from that process. It is the supplier or the agent or the wakil that is recovering the cost of mobilizing that capital from the beneficiary of the capital, right? You cannot put the cost of that capital to the supplier of the capital. That will be another injustice. You get that point? So here the organizations charge whatever name they call it. If it is not trading, if they call it service charge, they should make sure that the service charge is very much linked to the benefit provided to the lender. But that benefit cannot be provided to the borrower, and this benefit cannot be passed on to the lender or the saver, right? I am giving money to Mansoor Sahab. I am living somewhere. Mansoor Sahab sends his staff to collect my money, and that money is given to you. Now there is a transportation cost, there is a time cost, there is some effort cost. Somebody was employed to do this. All this cost has to be borne by the people who are benefiting from. It is not me. I should not be asked to pay for it when I have already given my liquidity free of cost. Okay?